Good morning, everyone, and welcome again to our bi-weekly meetup. Today, I have a very, very special guest, Randy, my good friend over the years, like I was saying earlier before I started the recording, that Matt and me, we are in competition to figure out who's best friends with Randy. Randy and me go back for many years. We come from the corporate background and I kind of had a similar trajectory into real estate. And Randy's doing really well. He's a coach as well. So today we pick a topic, developing a passive investment strategy. And I know there's a little bit twist in the topic today, but we'll cover vetting the sponsor at a later day. But today our topic is really interesting and I wanted to hear what Randy has to share with us. So Randy, stage is all yours.
Well, thank you, Vinky. It is a pleasure to be here, and welcome to everybody else too. Like I said, I know a lot of different people on this meetup and different stages of their development, from very advanced, just getting to meet Daniel there, who's gotten several hundred doors, and I'm sure others of you are maybe farther along, and others of you are just getting started. And so, the focus for me is really, as an individual, is really trying to develop a passive income strategy. That I started out with several years ago when I got into the real estate space. And so, see if I can advance the slides here. Here we go. So we got a full agenda to talk about. I'm gonna blow through that. Just a quick introduction to myself is I started InvestArc Properties about 10 years ago, when it came upon me that I was working for a private equity company, and my tenure was going to be rather short in terms of fear of getting laid off in the Great Recession time period. And coming out of that, I was working for a private equity company and realized that I really needed to develop another income strategy. And that's what was really my impetus for getting into commercial real estate. I started out in single family. I was a hard money lender, actually in the Dade County, Miami area, Daniel, and living in then Cleveland, Ohio. Got involved when I came to Houston with the Brad's Lifestyles in Houston. Was in Brad Sumrock's group for a while too, and recently I'm part of Rod Khalif's mastermind as well. I think he said I am a coach. Until about 4 months ago, I recently left my corporate world in the medical institution here in Houston, Texas. And I'm doing this full time now, and I'm really enjoying that. I have a couple advanced degrees there. That really doesn't mean anything in the real estate space. It's not essential. I think it just means that I'm probably a detail-oriented numbers kind of guy and enjoy it. On the personal side, my wife always tells me I need to talk about my personal life versus just the other side. So I'm married. I have 4 children. 5 grandchildren, and they're spread all over the country. And so we spend a lot of time traveling to see them. I mentioned I started in the multifamily space in 2014. And I think my advantage is that corporate experience, I think for me anyhow, brings a lot of discipline, accountability, task-oriented to the job of a full-time real estate person. You can see my numbers there in front of you. General partner in about 1,100 doors. I continually to passively invest in other people's deals. I just haven't found an asset class I like better, even as a finance guy. And I think what I'm focused on these days is creating passive wealth for investors. And I'm focused on, my avatar would be probably that seasoned professional who doesn't have the time to really look at details in terms of being an active or sponsorship, but wants to get real estate into their portfolio. And that's the kind of person I'm focused on. I think everybody encourage all my students to write down a goal. So I'm putting this out in front of you, making myself vulnerable. That it's a big, hairy, audacious goal, right? To have 500 new doors in the next 18 months. As we sit here today, I haven't got a clue how that's going to happen. But I got one right now in process, and we'll continue to focus on that, because if you don't have a goal, any road will do, right? So you'll get distracted, and if you don't. So before we really go into it, I really want to challenge the audience. What's your why? Why are you here today? I mean, think about it. Are you looking to really just grow your balance sheet? You want to have, millions of dollars. Maybe you're looking to present generational wealth to your children or your grandchildren. Or maybe you're like me and you just wanted to have another income stream to survive. It's kind of where I was at. None of those are bad, but I think it's important for everybody to define their why, because your why will drive your actions and the speed of which you're going to do this. And again, none of those strategies are wrong, but think about that. And I think there's three big elements to successful real estate and development. This isn't new with me, but really there's the top of the pyramid, which is mindset. Do you see yourself if you don't own any today, do you see yourself owning 500 doors, 300 doors? Maybe you've got 1,000 doors today. Do you see yourself being a general partner in 5,000 doors? And so it starts with, do you see yourself really being able to do that? And do you want to do it? This is an area I struggled with to start out with, quite honestly, because I'm a non-emotional guy, pretty much like a lot of guys. But once you get your head around that, it drives you. And then secondly, down in the left-hand corner is a mentor, right? So the mentor is going to help you determine and prevent failures, pitfalls. They're going to help you with the speed at which you want to accentuate your plan. So I really encourage everybody to find a mentor. There's a ton of them out there. There's the big box groups that I mentioned. I'm a coach, but there are many out there that you can tag along with. And if nothing else, go to your local meetups, find people, et cetera, like this in this network, follow people up offline. And then the bottom right-hand corner is the mechanics, right? That's how do you do it? And what are the tools to do it? And we'll spend some time talking about that today. I just also want to start with some basics because we got people all over on the spectrum. So what do we mean by multifamily? So generally we mean any property that's 5 units or more. You'll need to unlock your iPhone first. So we start with 5 units or more is considered a multifamily where you can get a commercial loan at. That's where a lender will allow you to have a commercial loan. We have all different kinds of classes, class A, B, and C. Be careful because very few people will advertise. I've never seen one advertised as a D in dog, but they're out there. So make sure you're not going after those. I hope you're well aware of the advantage of multifamily over other asset classes. The cash flow is what we're all seeking for. You get favorable tax treatment and forced appreciation. And that's what you need to tell your investors as to why they need to invest with you. Those are the 3 primary reasons. That differentiates it from the stock market and other things. You can get cash flow, but you can't get favorable tax treatment or forced appreciation in stocks and bonds. And then there's the other 3 I've listed here, which are really economies of scale of multifamily, right? Versus single family. Vacancy rates. If I have 1 unit empty and 100 units, I've got a 1% vacancy versus a single family. And the last one is the real kicker for me, non-recourse debt. When I realized I could buy a multi-million-dollar property, I should say, a multi-million-dollar property easier than I can buy my primary principal residence. It was an aha moment for me as to why we should more be looking at this. Because it's secured by the asset. It's not secured by my balance sheet or what the comps are next door. And that's a really distinguishing factor. Important we understand the risk of multifamily investing, right? There are risks. Nothing is free. It's a business. What's the property condition? I mean, the 3 most important things of real estate, location, location, and location, still resides with multifamily. Some areas are much better in growing than others and support that. What kind of financing are you getting? There's a lot of properties today under distress because they're using variable rate debt and with a lot of leverage. And so that has an implication. And you should know, and as an active or general partner, you need to sell that to your sponsor or to your investors and let them know in full disclosure. Property management is huge. We have, I use third-party property management companies. A lot of people have their own property management companies, but what's your experience in those markets? And I'm always amazed that we have multi-million-dollar assets And we have a person making $45,000, maybe $50,000 running these properties for us. And so you need to treat them very well and make sure you know their strengths and their weaknesses. But this last bullet point is where I kind of wanted to pause for just a minute. I don't know how many of you have heard the horse race illustration. What's the most important factor in a horse race? The horse or the jockey? Well, you'd say they're both important. Well, in the commercial real estate or in multifamily specifically, the horse is really the submarket or the property that you're looking at, and the jockey is the general partnership team. And I believe that general sponsorship team is the most important element you should be looking at. I've seen good sponsors make an average deal great, and I've seen poor sponsors make an average deal bad. So get to know them. That's the first element here. And so let's spend a little time on that. Factors to consider that you should really spend some time on. We can make this another whole session, Vinky, if we want to, but and there's more than 5, but we're going to talk just about those, and there's some bullet points under each. But first, you really have to know their track record. How long have they been in this space? And I just ask a lot of these questions. How long have they been in this space? What number of deals have gone full cycle? How many deals are they in? Do they specialize in any given market? Myself, I'm looking at the Sun Belt markets. Other people look, I got one friend that only does Tucson, Arizona, and he likes Tucson, Arizona. What are their returns historically? What's the average length of their investment? Is it 5 years, 3 years, 8, 10 years? Ask the problems they have encountered, or I call them learning lessons versus failures, because everybody's had one. And if they can't talk to you about it, that's probably a red flag in my mind. And I think if you're inhibited to talk to a sponsor or general partner about these, then you really need to get over that, because it's all on you as the passive investor. And as an active or responsive investor, you should be prepared to tell your investors these answers. What's your expertise and experience? Is this the first asset in the submarket you're looking at, or is this one of many in the submarket you're looking at? My friend in Tucson, Arizona, has got multiple assets in that market. He knows that backwards and forwards. Do they use third-party property management, or do they use their own? Or do they have their own fully integrated property management company? What's the property management's experience in that submarket area? Is this their first time in the market? What's their experience with that class of assets? Maybe they're experienced in working in Class A assets, and you're buying a Class C deal in Topeka, Kansas. Maybe they've never been to Topeka, and maybe they're only looking at Class A. So it's really important that you know that. Understand the exit strategies. What are their exit strategies? They're most likely always going to model it on a 5-year return because that's kind of the standard in the industry. But what's their history, and what are they really thinking? Are they going to refinance in year 3? Are they hoping to just flip it in year 2? Are they long-term? I have one guy that I passively invest with. He tends to be a much longer hold person. He lets the notes burn down to year 7 and 8. I'm fine with that. It's paying a distribution. It continues to appreciate, and we're paying down debt. But most importantly, you as either the passive investor or the general partner, you need to understand the risk in the deal. There are risks in all of them. This isn't, trees don't always grow to the sky. They're not going to be forever out there. So you need to understand those risks. And we talked about this in the horse jockey concept. What's the team strength? Is it just one GP, or is it many GPs that are leading this? And today you find the bigger the deals, the more GPs you have involved, I should say. And that's not bad. None of these are bad. But again, is this the first time the GPs have worked together? Or is this the 10th time they've worked together? Big difference. And they can share a lot of their successes. My favorite topic there, number 4, numbers matter. I said I'm a numbers guy. But if you don't know how to underwrite, you need to understand the assumptions in that, because all of you probably are aware that anybody can take a spreadsheet and make it look wonderful, can show a 25 or 35% IRR. But the question is, what's the reality of doing that? Is that feasible and likely to occur? And that is where experience, expertise, history, et cetera, come into huge play. And then to make sure that the general partners have stress tested those assumptions. What if we don't get a 10% rent growth? What if the reversion cap rate is much different? I think all of us wished a couple of years ago we would have stress tested interest rate rising much more than we did, because we're all struggling with that today. Really important that you understand how the GP earns their compensation. There are teams out there that look at, they're transactional. They make their money by really doing deals and getting the transaction fees. And that's not bad. That's not good, but just be aware of it. You really need to understand the capital stack. We could do another whole session on preferred returns versus no preferred returns and waterfalls. You just need to understand as a passive investor how you're going to get paid. And if you're a general partner, you need to explain that to your passive investors. So the other one here is I put down the fifth one is an investor is someone who understands the property, understands the associated risk, and puts their money in. A speculator is somebody that says, I like Vinky or I like Randy. There's $50,000. Go do what you do. Maybe they have enough money they can do that, but I'm just saying, be an investor versus a speculator. Understand the deal. Make sure you know of it. Some precautionary things here to think about as a GP. As an LP looking at GPs. First thing is we just gave you a bunch of questions there. If the GP won't talk to you about those, I think that's a giant red flag. They should be willing to take the time and help you feel comfortable on all those, if not more. Another one is make sure they have skin in the game. And I should put in parentheses here is beyond their acquisition fees. So you'll have a lot of sponsors that just roll their acquisition fee into the deal and they'll say they have skin in the game. I think that's a red flag. I think they need to have their own money in the deal in some way, fashion. Is somebody modeling a refinance in year 2 or 3 to achieve the returns? It should be able to stand without just a refinance. If there's only one manager in the deal, I would say be cautious. What's their track record? Really get to know them. I know of people that are one manager, but they have a full spectrum of employees behind them that help them. Never invest in the hood. Mike Becker, one of my mentors, drilled that into my head. Never invest in the hood. It's just going to may get some high returns start out, but it's just much more complicated. Is this a new market the first time you've ever done it? And then I said there are GP deals and there are investor-friendly deals. Know the difference. A GP-friendly deal is one that's heavily laden with fees, acquisition fees, disposition fees, et cetera. An investor-friendly deal has a solid cash-on-cash in return, and it's not heavily fee-laden. And that's just another thing to be looking at. So I said I encourage everybody to develop a passive strategy, and I encourage all my students to actually write it down, put it on paper, put it on the wall so that it helps guide you on your daily things so you don't get distracted like I do on the internet or email, but set those financial goals. There's nothing wrong with either of these. Maybe you want to be a GP, you want to own the property. Maybe you just want to stay as a passive investor. There's nothing wrong with either of those, and they're both wealth building strategies. How fast do you want to get there? What are the specific markets you want to look at? Are you going to look at every place that comes along your desk that has a high IRR? I would encourage you to hone in on specific markets and define the time frame for, I want to be an LP for 2 years, 5 years, then become active, or whatever you want to do. Avoid the shiny object syndrome. That's, again, why we're putting these on paper, so that when somebody offers you a 30% IRR in Topeka, Kansas, that you say, no, that doesn't fit my strategy. It's a it's a mobile home park, and I'm looking at multifamily. Because if your strategy says I'm only looking at multifamily in XYZ locations, you're going to quickly turn that away. Research, identify potential markets, hone in on something. I said I've narrowed it to the Sun Belt region, the southern half of the U.S., and have found partners in those markets with specific operating experience. It's a lifelong education. Continue to educate yourself and develop that long-term strategy, because it really changes as you mature. And then if you do want to become a GP, I'm just going to run through these so that we can leave plenty of time for questions and answers. But if you want to be a GP, how do you do that? And actually, if you're going to be an LP, ask the sponsor about these. How does he or she evaluate markets? I said I like the Sun Belt because it tends to have higher population income growth, where you at least mitigate risk that way. What are the economic indicators in those markets? Talk to the Better Business Bureaus. Finding and sourcing deals. If you're going to do this, you really got to get in comfort with talking to agents and brokers and networking with a lot of people to find deals. It's extremely competitive today. And then you have to learn how to analyze deals. And again, as a passive, you don't have to do all these, but you should certainly be comfortable enough and be able to talk these, underwriting, property conditions, et cetera. Due diligence, part of the plan. You got to develop a plan, or the GP's got to develop a plan. How are you going to do that? What's the business plan to really increase the NOI here and create that forced appreciation? What's the exit strategies? Once we got the business plan down, and then you're going to execute a letter of intent, you're going to begin to negotiate price. And this is why a lot of people want to be a passive investor, because they don't have to do all these things up to this point. And you also have to think about the property management. As we said before, they tend to make or break the investment, how it's done. Are you going to self-manage, or are you going to have a third party do it? And you have to talk about this transition from the previous seller to you. How are you going to transition this asset? Making sure you get all the contracts and the rent rolls and all the information that is necessary. And then once you do that, once you do all that and you close, then the hard work begins. You get to operate. And you're monitoring month to month, and you have to develop systems to monitor, in our case, the property managers, to ensure they're achieving our business plan. Then it's simply, if you want to do this, whatever you're doing, whether you're passive or active, it's rinse and repeat. It's refining your strategy, continuing to build teams, expanding your partnerships. You're doing great on Vinky's meetup here to just meet new people and see where they're at. I always encourage you, don't diversify until you're comfortable in this asset class. If you're going to do multifamily, great. If you're going to do self-storage, great. If you're going to do mobile home parks, great. But don't really jump from one asset class to the other until you are comfortable in one. And hopefully that will lead you there. So, and developing that investment strategy, we talked about the exit strategies for long-term growth, assessing the market, a property sale process, or the exit strategy, and take the long view is the most important thing there. As you do this, it's not done overnight, but it can be achieved over a longer period of time. I wanted to spend just a few moments, go over a couple of case studies with the audience so you can have a feel. Everybody talks about their success. I'm going to talk to you about one of the ones that was a real challenge, but I also ask here, was it? So this one was my first property that I invested in as a passive investor. 128 units, Port Arthur, Texas, built in 68. It had sat vacant, and a developer had bought it from the city and had begun to remodel and revamp it. Projected returns was $168,000 in 5 years. Wow, that's a really good return. A sponsor that, as a passive investor, that I know, liked, and trusted. And the business plan was simply to lease it up, refinance it, and then sell it. Well, that was in 2015, and that later that year, we did lease it up, and we refinanced it and got 60% of our money back. And I was thinking I was a really good investor. 2016, we found out the property manager was creating fraud. They were overstating revenues and overstating occupancies. 2018, we got hit by Hurricane Harvey and flooded 120, half of the first floor units, 65 units on the first floor, completely flooded out, 3 feet of water in them. And once we began to recover from all that, it took a lot of rebuilding. The distributions were stagnated. They had not had any since that refinance in 2015. So we sat there for 3-4 years without any distributions. In 2019, there was a fire on the property. 3 little children were killed, which is tragic. The owner, the tenant, the 3 young children home, she left the children home alone and went out. And when the fire occurred, tragically, they were killed, and she sued us as the property owners. And so, point of in all this is bad things can happen. We sold this in 2020, and I got all my money back. I didn't have any losses. So I think it was a lesson learned, and that's why I put it up there, that things can happen. The other one I just wanted to share very quickly is about the same time I invested passively in another unit in Beaumont, Texas. Projected return was 117. Again, experienced sponsor that I liked. Long-term seller had just taken their eyes off it. Business plan was real simple: make improvements, bump rents. And 2017, though, we had that Hurricane Harvey again, flooded part of this operations. And first floor units, about half of them were vacated and had to be completely rebuilt. And distributions were paused in the whole time period, for about a year and a half. And then we sold it in 2018 at 4x our investment. 4x our investment. So if you put in 50,000, you get 200 back, or whatever the multiple was. So what's the difference in the two? I thought both of them were great to start with, but they had drastically different outcomes. I think my intent of all this is it's a business. Just make sure you know the sponsor, and then, develop your plan. What's right for you? It's different than everybody else, either as a passive or an active. I always say, ready, aim, fire. I don't know if you've heard this illustration, but I'm a finance technical guy, so it's my weakness is I ready, aim, fire. One of my partners was a marketing guy, and I think he fire, aimed, ready in the illustration. And so my point of it is just know your partners, the GPs, but take some massive action, and it's achievable. It's just over a long run. So with that, Vinky, let me see if we got any questions.
Yeah, I think that was a super awesome presentation. And I really love it how you started with the why, because everybody has to understand that why they are doing something, not just because, oh, my next door neighbor is doing that, or Matt is doing that, or Andy is doing that, I wanted to do that too. So it's very important to understand what your why is, and that's going to help you achieve your goals. And the second thing that you mentioned, kind of briefly, I'm going to touch on that, is that you need to know your address, where you want it to be, your vision, your future you. Unless you have your address, you won't be able to get there. So that address could be $10 million, $20 million, $2 billion, whatever is it for you. So even if you think it's too big, it's okay. You don't have to share with anybody. Just keep it to yourself, break it down to smaller chunks and try to achieve that slowly. And I really love your horse and jockey analogy there too. And how you mentioned, horse and jockey both are important. A lot of time people talk about jockey is really important. Yes, in some cases, but the thing is, jockey is like super savvy and knows that the horse is going to help him win, and they keep the horse groomed and in good shape. and then always so that it's just helping them achieve their goals faster. So I really love that. And the other thing that I wanted to ask a question about is, I know there's a question about the capital stack. I would like you to touch on that a little bit, and maybe we can spin off another meetup on that where you can dig deeper and share more knowledge there. But right now I wanted to talk about numbers. You touched on that and you said you need to know your numbers. But as a passive investor, when you come in the deal, only thing people look at is, like you said, shiny object, 20% IRR. I'm getting 30% annual return. I'm getting 5x multiple. And that's the kind of drawing factor towards the deal. I would like you to touch on that and then share with us what is the best possible way, like 5 minutes, 10 minutes kind of vetting the deal, like is the right fit for me.
I think that varies for everybody in their comfort level and how much you know the sponsorship team. So when I first got started in this business, I said I was very reluctant. I would never, as a passive investor, I would never invest in an asset unless I drove the asset and I drove the submarket and looked at the units. And sometimes that required me to get on a plane and actually go to the asset and look at it. So until you gain comfort with the sponsorship team, I've got some sponsors I've done multiple deals with. And I'm real comfortable with their approach and their style. But until you get that comfort level, I really encourage you to go deep on the first one. So for me, it's looking at the asset, getting your eyes on it and the submarket and the comps around it and trying to understand it, what differentiates it. I think you really have to understand some of the assumptions in the underwriting. For me, it's what's the rent growth assumptions, what's the expense growth assumptions, what's the reversion cap. Those are just top of mind factors that greatly affect the return. They just greatly affect the return. How realistic is it to get a 20% rate rental rate increase these days? Very slim. Well, what's the probability of 5%? Probably much better. But you really have to ask some of those questions. Those are three I'd start out with right there. What's the rent growth? What's the expense growth? And what's the reversion cap rate? And if you don't understand the reversion cap rate, that's basically the cap rate that you're looking at when we sell the property. You're forecasting that 5 years down the road. And that is a very variable. You'll see some people be very assertive in that and very aggressive. So if at a minimum, I would say the reversion cap rate should be greater than the buying cap rate for.
Yeah, sure. Why is that? And I have seen the deals where it's lower and then it's a complete no-no to begin with that. So shed some light on that. I think Barb has a question regarding that as well.
I think Barb said, can you explain reversion cap rate? I'm not familiar with that. I see it in the chat if that's Barb's question.
Yeah.
So I think the reversion cap rate is that simple. What I said is it's the cap rate 5 years out into the future when we're going to sell the asset. And so you buy it at a cap rate. That's the, you buy it at a cap rate, which is the net operating income over the purchase price. That's a cap rate. And you're going to forecast what that is in year 5 or 6 when you sell the deal. And when you do that, it greatly affects the market value because that cap rate divided by the operating income is going to be your basic market price to sell it at. So you need to just understand that. If it's above the cap rate, so if the exit cap rate is greater than the selling cap, if the exit cap rate is greater than the buying cap rate, that's a fairly safe. I would say it has to be at least 50 basis points higher. In today's market, even greater, because cap rates are rising now. It's unrealistic to think they're going to go down in the foreseeable future again. Perhaps that'd be a very pleasant surprise if they did, but you have to really anticipate them rising and how much are you comfortable with.
Great. And there's, and then it's, directly related to the NOI, basically your cap rate. So if you're showing higher at the exit, meaning your projections are higher NOI over the course of time. So that gives you better outlook into the deal. And can you touch on capital stack as well? I think Barb has a question about capital stack earlier. She put it in there. She wanted to know how maybe exactly cap stack works with the pref. I'm looking for the question if I can find it.
That's right. I got another whole presentation, that one. But to summarize, the capital stack is there's usually the simple capital stack is referred to as the 80-20. So that means the limited partners get 80% and the general partners get 20%. And then there's the preferred capital stack, which is the limited partners. These can vary, but generally you'll see the general partners getting 30% and the limited partners getting 70%, but there's a preferred return in there. And so on the advantage of that model of the complex is you get a preferred return, but you get a lower percentage rate. And there are advantages and disadvantages to that. I prefer the simple capital stack myself, but I know investors tend to like complex where you have a 70-30 with a pref.
Thanks. And there's another question from Vas. He's asking, do you all underwrite from a probability perspective? So actual calculate the combination probability. Vas, you wanted to come on board and ask your question live? Vas, you're there? You want to
Hi guys, I'll try. I meant to say underwrite risk.
Okay.
But I have a baby background. So underwrite risk from an actual numerical probability standpoint.
I think the way you see it, Wes, is most likely is how are they stress tested? So each of the underwriting models generally has a template. They should show it to you in the investor summary to investors, and they should show you their stress testing methods. So at a minimum, they should be stress testing rent rates. They should be stress testing reversion cap rates at a very minimum for you to say that because of the impact of those. And they should show that to you in the investment summary.
Good. Appreciate it.
Okay, do we have any more questions for Randy at this point?
Well, I'm glad you and Matt are not asking any hard ones.
Yes, I have a question for Randy.
Mm-hmm.
Randy, you mentioned you'd like to acquire another 500 doors. What are you looking for from anyone on this call to help you with doing to accomplish that goal?
Well, I think as a syndicator, there's two primary activities that I think you do all day, every day. I'm trying to focus on finding properties that may fit that criteria that are something I'm comfortable taking to investors. And then the second item that syndicators always focus on is finding investors that may be interested in coming alongside of you. So it's a very long lead time, as we talked a little bit in the introduction, Daniel, about finding investors. And
my problem is finding investors, not finding properties. So maybe we can have something to help each other. If you can send me your criteria of the property you're looking for, you said Sunbelt State.
If you send me, that QR code there has got my contact information, send me an email. And if you just take a picture of that, it'll show you all my contact information.
Yes, I will do that. If not, thank you.
Thanks, Daniel. Any more questions for Randy?
I see Daniel wanted to connect to I'm sorry, Daniel, we just talked about that. That's fine.
Yeah. Somebody
else wanted to connect, and I guess I would say just use that QR code right there. That's got my email, my phone number, and everything else.
Okay, so seems like we do not have any more questions, Randy. Thank you so much for the presentation. I think that was a really good presentation, and it covered mostly from why you should get into something, and then how you can keep a tab on your things, as you go along. And also you talk about, not just getting the knowledge, taking action too. That's very important, and networking with people, expanding your network, and look all the resources around you. Look at all the money around you. There's so much money around you, So don't feel that you're struggling for anything. All the resources around you, you just learn how to connect the dots. And with that, I will say again, thank you so much for being with us today. And we do have 15 more minutes. And are we up for one round of networking?